All right, let's jump right in. Today's explainer is focused on Atlas Copco, which is an absolute powerhouse of European industrial tech. And honestly, we're catching them at a truly pivotal historical moment. So let's get into it. Right off the bat, we're faced with a pretty crazy paradox. How exactly does a traditional industrial giant, we're talking a company founded way back in 1873, transform into a high-tech darling that's literally critical to the AI revolution? Bridging that gap is the secret to understanding this company's massive momentum right now. Okay, here's a quick roadmap of what we're going to cover. 1. An industrial giant awakens. 2. Record-breaking Q2 results. 3. The semiconductor vacuum engine. 4. Wall Street's bullish verdict. And 5. Key risks to consider. Starting with Section 1, an industrial giant awakens. Before we talk about where they're going, we kind of have to respect the sheer scale of where they've been. Founded in Sweden over 150 years ago, this is definitely no sleepy legacy firm. By 2025, they were pulling in 168 billion Swedish kroner in revenue, backed by an army of 56,000 employees. And now, as we push through 2026, they are positioned squarely at the center of the AI and semiconductor supercycle. Just a super quick note before we start talking numbers, this explainer is strictly for informational purposes, not financial advice. All investments carry risk, so always do your own research or consult a pro. Moving on to Section 2, record-breaking Q2 results. So in mid-July of 2026, Atlas Copco released an earnings report that basically forced the market to pay attention. The magnitude of this beat is just wild. Orders received spiked 27% to almost 51 billion SEK. Revenues climbed to nearly 45 billion, and operating profit hit 9.25 billion, boasting a really stellar 20.6% margin. This wasn't just a solid quarter, this was a seismic shift, with order intake absolutely smashing analyst expectations by over 13%. To put a human voice to all that data, CEO Wagner Rego summed it up perfectly at the time, saying, "The demand for Atlas Copco Group's products, services, and solutions improved significantly, particularly from the semiconductor industry. We delivered double-digit order growth in all business areas." The real takeaway here is the breadth of that success. It's broad-based across every single division, and management confirmed they fully expect customer activity to stay at these heightened levels. Which brings us to Section 3, the semiconductor vacuum engine. To understand what's fueling this massive breakout, we have to talk about one staggering number: 59%. That is the organic growth in orders that Atlas Copco saw in their vacuum technique division during the second quarter alone. Just huge. So why is the vacuum technique division exploding like this? Well, it's because these specific vacuum pumps and exhaust systems are literally essential for fabricating advanced semiconductor chips. Without this highly complex plumbing, you simply cannot manufacture the chips that run the AI tools we use every single day, like ChatGPT or Midjourney. It makes total sense why Bloomberg described them as the hidden engine of the AI boom. And the crazy part is, this looks like just the beginning. The multi-year forecast from UBS for wafer fabrication equipment capital expenditures shows an incredible runway. We're looking at projections of a 27% increase in 2026, ramping up to a massive 35% jump in 2027, and staying hot with another 25% in 2028. UBS actually raised its own vacuum technique order growth assumptions for the company to match this wave. And Atlas Copco isn't just sitting on their hands. Management confirmed they are actively ramping up factory output to meet this incoming tsunami of demand. Okay, let's look at Section 4, Wall Street's bullish verdict. Unsurprisingly, when you post numbers like that, the financial sector reacts in a big way. Just look at the spike in analyst sentiment. Before the Q2 report, about 69% of analysts had positive recommendations. After the report dropped, that shot up to 84%. According to S&P Global, out of 21 polled analysts, the stock now carries a very strong consensus buy rating. And the major banks are basically falling over themselves to update their price targets. You've got targets ranging from 215 SEK over at Morgan Stanley all the way up to 250 at JP Morgan, which pushes the average consensus up near 217. Even historically cautious voices, like UBS, upgraded the stock and bumped their target up by 45 SEK. Actually, let's zero in on Goldman Sachs' specific rationale for a second, because I think it's super revealing. They upgraded the stock from neutral to buy in late July, specifically forecasting that Atlas Copco's growth is going to accelerate to a 13% compound annual growth rate over the next 3 years. That is up significantly from just 6% over the last 3. Plus, they expect return on invested capital to exceed 25% by 2027. Efficiency like that places the company firmly in the top quartile of the entire industrial sector. But it's not just about future growth, they're actively rewarding shareholders right now. At the 2026 annual general meeting, a total combined dividend of 5.00 SEK per share was approved. That breaks down to a 3.00 SEK ordinary dividend plus a really generous 2.00 SEK extra distribution. Paid out in 2 equal installments of 2.50, they're effectively routing that massive operating cash flow straight back into investors' pockets. Section 5. Key risks to consider. Now, every good explainer needs a reality check, so let's neutrally outline the bear case. There are basically 5 distinct threat vectors here. First up, currency. They have significant US dollar exposure, and management is actually expecting a 1 billion SEK hit to the bottom line because of it. Second is cyclicality. Chip demand historically runs on a boom and bust cycle. Third, geopolitics. Global unrest and US tariffs are causing some very real customer hesitancy. Fourth is competition, particularly from emerging Chinese rivals. And fifth, valuation. The stock definitely trades at a premium, even though some analysts argue it's totally deserved. So, bringing all this together. On one hand, you have this massive structural upcycle, driven by an unprecedented wave of semiconductor capex, which is entirely validated by blowout Q2 numbers and Wall Street upgrades. But on the other hand, you have very real macro risks: currency hits, geopolitical tension, and inherent cyclicality. You're basically weighing the ultimate backdoor play on the AI boom against the gritty realities of global manufacturing. Which really just leaves us with one provocative question. Does a 150-year track record, an incredibly strong aftermarket base, and consistent returns provide enough of a safety net against the modern, highly volatile risks of the semiconductor space? It is a fascinating dynamic to watch play out. As always, I definitely encourage you to do your own research and weigh these factors for yourself. Thank you so much for joining me for this explainer, and I will see you on the next one.